Welcome. In this video, Zbcn can increase 950%. What is the reason? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
When analyzing price movements in the markets, one of the important structures we often encounter is the falling curve pattern. As the name suggests, the falling curve is a structure where the price follows a downward movement over a certain period, forming a curved shape on the chart rather than a straight line. This type of structure usually emerges as a result of prolonged selling pressure, showing that the price gradually moves to lower levels over time, but in a smooth curve rather than a sharp decline. In such situations, market sentiment is mostly pessimistic, the majority of investors hold short positions, and buyer interest is very limited. However, it is precisely in such cases that a very critical level comes into play from a technical analysis perspective, the moment the price breaks above the falling curve. When a price moves below a falling curve for a long time, the curve acts almost like a ceiling over the price. Every attempt to rise is blocked by this curve, and the price turns back down again. This reinforces the perception among investors that the price won't rise anyway. However, no trend in market dynamics lasts forever. Selling pressure eventually decreases, buyers start to step in again, and the price approaches the point of testing the falling curve. At this stage, breaking above the curve is considered a breakout in technical terms, and this breakout is often the beginning of a new upward wave. This breakout is not just about surpassing a line or curve level, it's also a sign of a fundamental change in market psychology. Breaking above a curve that has acted as a strong resistance and kept the price below sends the message to investors that the sellers have lost their strength. This, in turn, increases buyer interest. In technical analysis, this is considered a strong move that can signal a trend reversal. Several factors determine the strength of the rally that begins after the falling curve is broken. First, the breakout should be supported by volume. A high-volume breakout shows that market participants strongly believe in surpassing this level and are taking positions. A breakout without volume often results in a false breakout. Therefore, simply moving above the curve is not always enough. Confirmation with volume analysis is important. Additionally, after such a breakout, there are often pullbacks. This means the price moves above the curve, rises for a while, then pulls back to retest the broken curve level. If the price turns upward again during this retest, it indicates the breakout is solid and the uptrend may continue. At this stage, it becomes more likely for the price to make new highs and accelerate its rise. From a psychological perspective, breaking the falling curve changes market sentiment. Even investors who have become accustomed to the downtrend for a long time start to think, could the rise be starting now? Initially cautious investors gain confidence as the price continues to rise steadily after the breakout and start buying. This accelerates the price increase. Especially since large funds and algorithms that use technical analysis monitor such breakout levels, automatic buying can be triggered when the price moves above the curve. In such a scenario, the size of the rise following the breakout is often proportional to the price movements measured from the start of the curve. For example, if the price lost 50% in value within the falling curve, the breakout could offer at least half of that drop in upward potential. This potential could be much greater depending on market news, the overall trend, and investor interest. Once the price breaks the curve, the intermediate resistance levels formed during the previous downtrend start to be tested one by one. These resistances are usually broken quickly because the market direction has shifted and strong upward momentum has begun. Breaking the first major resistance after the breakout marks the second stage of the rally. Another point to note is the news flow that may occur after the breakout. If a positive fundamental development happens around the same time as the technical breakout, for example, good news about the company or project, positive developments in the sector, or regulatory improvements, the rise can be much sharper. In technical analysis, breakouts supported by such fundamental factors tend to reach target levels much faster. In conclusion, moving above a falling curve is a very important technical development for the market. This move can signal the end of a long-lasting downtrend and the possible beginning of a new uptrend. If the price continues upward after breaking this level with volume support, it boosts investor confidence and makes the rise more sustainable. Investors who spot this breakout at the right time can capture the highest potential gains from the trend reversal. However, like every technical signal, this breakout should also be evaluated with risk management, as unexpected moves can always happen in the markets and even strong technical setups can fail. Therefore, investors looking to take advantage of a falling curve breakout should carefully monitor both technical confirmations and market conditions. But we cannot base our analysis solely on the curve, so let's take a look at the other metrics as well. Keep watching.
The falling trend formed in the RSI indicator is a highly notable signal in technical analysis, closely monitored by investors. RSI, or Relative Strength Index, is a momentum indicator that measures the speed and magnitude of price changes over a specific period. It usually ranges between 0 and 100 and is used to identify overbought or oversold zones in the market. However, RSI is not interpreted solely based on these levels. Just like in the price chart, trend lines, patterns, and breakout levels on the RSI are also monitored. This is where the concept of a falling trend in the RSI comes into play. When the price of an instrument has been moving downward for a long time, the RSI usually remains at lower levels and forms consecutively lower peak levels during this process. When these peaks are connected, a downward sloping trend line appears on the RSI chart. This falling trend line shows that the RSI, like the price, has a certain resistance area. In other words, although the RSI occasionally reacts upward, it turns downward again when it approaches this falling trend line and momentum weakens. This indicates that the market still does not have a strong desire to rise and that buyers are not dominant enough. However, in technical analysis, it is known that every falling trend can eventually be broken. A breakout of this falling trend in the RSI can signal that momentum has started to reverse and that a significant change in market psychology is taking place. Since the RSI measures the speed and strength of price movement, breaking the falling trend upward means that the price will likely show stronger upward moves in the short term. Especially in a long-term downtrend, such a breakout in the RSI can be a strong technical signal that the price may be reversing from a bottom area. When the falling trend in the RSI is broken, a similar breakout usually occurs in the price chart as well. For example, the price may also break its own downward trend line upward or surpass a resistance zone. Such simultaneous breakouts are considered one of the strongest signals in technical analysis, as both momentum and price are changing direction. This can often be the beginning of a longer-term upward trend. Breaking the RSI's falling trend also significantly affects market psychology. Investors who have been in a downward trend for a long time may regain hook after such a breakout and start buying. This can contribute to the price rising more quickly. Especially algorithmic trading systems and large investors focused on technical analysis can use such momentum breakouts as buy signals. Therefore, after an RSI breakout, sudden spikes and sharp upward movements in prices can be observed. Another factor to monitor after a falling trend breakout in the RSI is the first pullback following the breakout. Often, after breaking out, the RSI will experience a slight pullback and approach the broken trend line. If it turns upward again at this point, it confirms that the breakout is valid and the likelihood of a rise increases. This is the RSI version of the classic technical pattern known as a pullback or throwback in the price chart. In addition, the level at which the RSI breakout occurs is also important. If the breakout happens near the 30 level in the oversold zone, it often indicates a strong recovery potential because the market is oversold and sellers are starting to lose strength. On the other hand, if the breakout occurs above the 50 level, it shows that the already positive momentum is gaining even more strength and the rise is likely to continue. When a falling trend in the RSI is broken, previous RSI peaks and price resistance levels are usually taken into account when determining target zones. For example, after the breakout, the RSI may quickly move toward the 70 level and the price may test its previous highs in parallel. During this process, investor behavior can change rapidly, especially when the price approaches psychological levels, such as round numbers or previous peak prices. In conclusion, a falling trend breakout in the RSI is a highly important signal in technical analysis. This breakout shows that the market is beginning to emerge from a prolonged period of weak momentum and that buyers are regaining strength. Especially if the price also breaks a significant resistance to the upside during the same period, it can be a strong confirmation of a trend reversal. Therefore, investors who detect falling trend breakouts in the RSI early can have the opportunity to maximize potential gains from an upward move. However, as with any technical signal, risk management should not be forgotten because there are no certainties in the markets and even the strongest breakouts can sometimes fail. For this reason, interpreting RSI breakouts together with both technical and fundamental data is critical for making healthier investment decisions.
The ascending channel formation is an extremely important structure in technical analysis for determining the direction of the trend and the potential price movement range. This formation occurs when the price fluctuates between two parallel rising trend lines. The lower line acts as support, while the upper line serves as resistance. In the middle of these two main lines, there is usually a midline. The midline can be thought of as an imaginary line running right through the center of the channel, representing an area where the price reacts and determines direction. The midline often represents minor support or resistance levels within the channel. When the price passes above this midline, the next target is usually to test the upper band. By nature, in an ascending channel, when the price rises above the midline, it indicates that buyers have gained a stronger position in the market and are increasing momentum. The midline is almost like a short-term psychological boundary for the price. A breakout above this level often acts as a trigger that pushes the price toward the upper band. From this point on, buyers tend to set their sights on the top of the channel, while sellers generally pull back or postpone profit-taking. A potential increase as large as 950% shows the tremendous profit opportunity that emerges when the distance from the midline to the upper band is measured relative to the current price level. This situation is often seen in long-term channel formations and when buying from deep low levels. For example, if the price recovers from near the lower band of the channel and reaches the midline, the price increase required to move from there to the upper band can sometimes be expressed in very high percentages. That is why such a 950% potential increase strongly attracts investors' attention. Breaking above the midline is not only a numerical target, but also creates a significant shift in market psychology. An asset that has been priced below the midline for a long time, once it breaks this level, makes investors see the possibility of a new rally as more likely. This especially accelerates buying decisions for traders who operate based on technical analysis. Many algorithmic trading bots also interpret such midline breakouts as buy signals and open automatic positions. This increases volume and helps the price reach the upper band more quickly. During the process of moving from the midline to the upper band, it is normal for the price to experience small pullbacks from time to time. However, these pullbacks are usually short-term, and since the midline now acts as support, the price tends to turn upward again. In other words, the midline which previously acted as resistance begins to serve as support once broken. This is a reflection of the resistance becomes support principle, frequently seen in technical analysis. If this transformation is supported by strong volume, the price's progress toward the upper band becomes almost inevitable. Targeting the upper band means, technically, that the price is approaching the strongest resistance area within the channel. At this point, many investors may take profits. However, by the nature of the ascending channel, if the trend is very strong and there is positive news flow in the market, it is possible for the upper band to be broken and the price to move above the channel. In such a scenario, the upward momentum increases even further, and prices that move above the channel often display a parabolic movement. In this case, even the 950% target could be exceeded. A massive potential increase like 950% is often the dream of long-term investors. Such a rise is not only a short-term trade, but also a strategy that can multiply a portfolio. For example, if an investor takes a position before this breakout, they can make significant profits during the move from the midline to the upper band. Risk management is also important in this process. After the midline is broken, setting stop-loss levels in case the price falls back below it is essential to protect against possible reversals. One of the factors that affect the speed of price movement from the midline to the upper band is overall market sentiment. If the general cryptocurrency or stock market is under positive news flow, investors become more willing to take risks. This accelerates the post-breakout rally. Conversely, if the general market is in decline, it may take longer for the breakout to reach the upper band. However, as long as the price remains within the ascending channel, the main trend direction remains upward. Finally, in such an ascending channel, a 950% target provides investors with very strong motivation both technically and psychologically. From a technical perspective, the target is clear. From a psychological perspective, such a large potential keeps investors patient in holding their positions. By the nature of the ascending channel, whenever the price pulls back, it tends to bounce back upward from the lower or midlines. This gives investors confidence. The journey that starts with the midline breakout is technically supported until the upper band is reached, and each new rise brings the investor closer to the target.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.